Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Battalion Oil.
If you find our talks useful, please consider subscribe, like, and comment underneath. And, imagine looking at a company's balance sheet and just seeing an absolute bloodbath. I mean, sales plummeting, earnings swinging to a heavy loss.
Right, just ugly data all around.
Exactly. The data is staring you right in the face, and usually your instinct as an investor would be to just run as fast as possible in the opposite direction.
Yeah.
But what if I told you the smartest institutional money on Wall Street is quietly buying up pieces of this exact company right now?
Yeah, it really is one of the most compelling paradoxes you're going to find in the market today. Because, well, we're looking at an independent energy producer that recently posted undeniably disappointing fourth quarter numbers. I mean, they were bad.
Oh, for sure. Really rough.
But the core mission of our talk today is to understand how these massive macroeconomic shockwaves, global historic shifts in supply and demand, how they can completely override a company's past performance.
Right, because it's not just about what happened yesterday.
Exactly. It's about recognizing how a seemingly battered stock can actually transform into a high-leverage opportunity for you.
Yeah.
For the astute investor, provided you know how to read the broader environment.
Yeah, because wealth building isn't just about like reading a spreadsheet of what happened 3 months ago. The market is a forward-looking machine.
100%.
But to understand the opportunity, we have to respect the reality of the risk. So let's just rip the Band-Aid off and look at the ugly data first. The fourth quarter was undeniably rough. We saw their sales drop heavily, falling from roughly $49.6 million down to about $32.2 million year over year.
Yeah, that is a steep cliff. A very severe contraction.
It really is.
And when you look at the bottom line, their adjusted earnings per share swung to a loss of $1.16. And to put that in perspective for you, during the same period the previous year, they reported a relatively tiny 4-cent loss.
Wait, a 4-cent loss to a $1.16 deficit?
Oh.
How does it spiral that quickly? I mean, that's a massive jump.
Well, it really comes down to the operational realities of being an independent energy producer. In the upstream energy business, your capital expenditures, keeping the drilling rigs operational, maintaining the leases, paying the specialized crews.
Like the heavy overhead.
Exactly. Those are relatively fixed costs in the short term. So when the spot price of your product drops and your total sales volume contracts like we just saw, you don't get to just instantly turn off your overhead expenses.
So the costs stay high while the money coming in just vanishes.
Precisely. That revenue contraction violently compresses your profit margins. It proves that the company was clearly struggling with pricing pressures and operational headwinds in that specific quarter.
But so here's where the narrative completely flips. Despite that significant earnings miss, there is this unprecedented bullish pivot happening in the background.
Right, the macro shift.
Yeah. Goldman Sachs is currently out there warning the market about potentially the largest oil supply shock on record. And this is driven entirely by geopolitical disruptions in the Middle East.
It's a massive external factor.
It really reminds me of a sports analogy. It's like a team that had a terrible regular season, right? Just awful. But they just barely made the playoffs. And suddenly the weather conditions perfectly favor their specific style of play. It doesn't matter how bad they were in November, right now the environment is built for them to win.
That is actually the perfect way to visualize the financial leverage at play here, because you have to understand why the broader market is suddenly willing to look past that weak March earnings report.
Because the game has changed.
Exactly. In the context of building wealth, backward-looking fundamentals often take a backseat to forward-looking macro environments. If crude prices stay elevated because of these historic supply shocks, this company's revenue trajectory is going to experience a sharp, violent reversal upward.
So the bad quarter actually sets them up for a bigger bounce.
Yeah, the incredibly low baseline of that weak fourth quarter actually makes their potential percentage growth look even more explosive moving forward.
Okay, so the macro environment might be throwing them a lifeline, but I mean, you can't ride a tidal wave if your boat is already full of holes, right?
You need a solid foundation.
Yeah, so how is Battalion actually ensuring they stay solvent long enough for this oil spike to hit their bottom line? Because to survive that bad of a quarter, they need a fortified balance sheet.
This is a crucial point. When a company misses earnings that badly, the immediate concern for any investor is liquidity. Like, can they literally keep the lights on?
Exactly. Cash is king.
Yeah. And behind the scenes, they have actually been executing a very significant de-risking strategy. The most critical move they made was reducing their outstanding debt by $40 million.
Wow, 40 million.
Yeah. And in the world of small cap energy producers, high debt is the anchor that drowns you the moment commodity prices drop. Removing $40 million from the liability side of the ledger substantially improves their operational flexibility.
Right, because it removes a heavy burden of interest payments.
Yeah,
You're not just burning cash to service debt.
exactly.
But wait, hold on. Let me challenge this survival narrative for a second here.
Sure, go ahead.
We're sitting here praising them for shedding $40 million in debt. But in the exact same breath, the data shows they had to turn around and execute a private placement agreement to raise $15 million. And that specifically netted about $14.1 million strictly for working capital.
Right.
Isn't that just, shuffling deck chairs on the sinking ship? I mean, you pay down debt on one side, but you dilute your equity on the other just to keep the lights on.
Well, it is a completely fair challenge, and on the surface, it does look contradictory, but we have to look at the underlying mechanics of that specific transaction.
Okay, break that down for me.
A private placement isn't like retail investors buying shares on a trading app. It involves sophisticated institutional investors who conduct deep due diligence.
The smart money, basically.
Exactly. And these entities agreed to lock up their capital at $5.50 per share. So when institutional money is willing to inject $15 million into a company that just missed earnings so badly, it signals a strong conviction that the downside is capped.
Oh, I see. So they're basically setting a floor.
Right. That capital infusion entirely removes any near-term bankruptcy risk from the thesis. It acts as a bridge. It allows them to bridge the gap to higher oil prices.
Okay, I see the distinction there. That makes sense. So let's talk about their actual operational footprint then, their protective moat, because they hold premier liquids-rich acreage in the Delaware Basin, right?
Yes, very prime real estate in the energy sector.
And they also recently acquired over 7,000 net acres in Texas. Plus, they just partnered with Targa Resources to boost their gas processing capacity up to 30 million cubic feet per day.
Which is a massive operational upgrade.
But here's what I really want to understand about the leverage here. If crude prices spike globally, why does a small independent producer in the Delaware Basin benefit more than, say, a colossal diversified oil giant?
That's a great question.
Like, why does the smaller player give you better torque on the trade?
It all comes down to the mechanics of being a pure play upstream producer. So think about an integrated major, the giant household names you see at the gas station.
Right, the massive global brands.
Yeah. Their business is heavily diversified. They drill for oil, but they also transport it, they refine it into gasoline, and they sell it directly to consumers.
So they own the whole pipeline.
Exactly. So when global crude prices spike, their drilling segment makes an absolute fortune, yes, but their refining segment actually suffers.
Wait, why does the refining segment suffer?
Because the cost of the unrefined oil they need to buy just skyrocketed. Their own internal input costs go up, which eats into their overall profits. They don't capture the entire profit margin of the price spike. Oh, wow. Because they are basically selling the raw material to themselves at a higher price down the supply chain.
Precisely. But a pure-play upstream company only focuses on pulling the resource out of the ground and selling it at the spot price.
Ah, so no refining baggage.
Exactly. So when crude goes from $70 a barrel to 90 or 90 to 100, they capture that full margin expansion. Every single incremental dollar of price increase drops straight to their bottom line.
That is incredible leverage. But what about that partnership with Targa? The one to boost gas processing to 30 million cubic feet per day. Why does a crude oil producer care so much about natural gas processing?
Well, because in regions like the Delaware Basin, oil and natural gas often come out of the ground together. The gas is a byproduct. It's known as associated gas.
Okay, so it just comes up naturally with the oil.
Right. And if you don't have the midstream infrastructure to process or pipe that gas away, regulatory bodies will literally force you to shut down the well.
You're kidding. They'll shut down an oil well over gas. Yes, to prevent excessive flaring. You cannot pump your highly lucrative oil because you have nowhere to put the byproduct gas.
Wow.
So by partnering to secure that processing capacity, they remove a major operational bottleneck. When oil prices spike, they can pump at maximum capacity without being constrained by infrastructure limits.
It's fascinating. It's not just about having the oil under the ground, it's about having the plumbing to move it.
Exactly.
And because they acquired those new 7,000 acres right next to their existing facilities, their marginal cost of production is much lower. They just plug into the infrastructure they already have.
It's highly efficient.
So we have the fundamental setup here.
Hmm.
The balance sheet is secured, the operational bottlenecks are cleared, and global supply is threatened. Let's pivot to how traders are actually pricing this reality, because the stock chart has been absolute whiplash.
Oh, the volatility has been extraordinary, truly.
We are talking about textbook high beta commodity behavior. I mean, back in early March, we saw the stock essentially double in value. It surged well over 113%, testing highs near $11.80.
Yeah, that was a wild run.
At one point, it gained over 80% in a single trading session. We saw overnight gap ups where you'd wake up and the stock was suddenly 33% higher than when you went to sleep.
Which is a clear indicator of extreme market urgency. The market was scrambling to price in the macro news.
But because this is a high beta stock, meaning it acts like a trampoline, dramatically amplifying whatever the broader market or sector is doing, we immediately saw a brutal pullback. On March 25th, following that weak Q4 earnings report we discussed, the stock took a severe 40% drop.
A massive haircut.
Yeah. And the trading volume during this period was staggering. We saw volume spike to $260 million. That's 188% higher than previous days.
Just a tidal wave of capital.
Right. That kind of volume made it one of the most heavily traded stocks in the entire market for a brief window. Now, if you're listening to this and looking at that 40% drop, your instinct is probably screaming at you not to catch a falling knife.
Naturally.
I mean, why touch a stock that the market just brutally punished? How should an investor interpret a $260 million volume spike alongside a massive drop?
You have to separate retail panic from institutional strategy. A $260 million volume spike is not everyday retail investors buying a few shares on their lunch break.
Right, that's not retail money.
No, that is algorithmic trading programs, hedge funds rebalancing, and heavy institutional money changing hands. It is a textbook fear trade. To understand the 40% pullback, you really have to look at the psychology of the chart.
Okay, what is the chart telling us?
Well, when a stock surges past 100% in a matter of days and hits $11.80, it establishes a resistance level. That is the ceiling where early buyers step in and say, okay, this is high enough, I am taking my profits.
They cash out, which obviously creates a ton of downward pressure.
Right. But that subsequent 40% drop wasn't necessarily the end of the narrative. What the market is actually doing during that heavy volume period is attempting to find a support floor.
Probing for a bottom.
Exactly. They are probing for a baseline where new buyers believe the underlying value is simply too good to pass up. And the technical data suggests they are trying to establish that support floor somewhere between $9.50 and $11.
Ah, so it's settling into a new range.
Yes. So from a strategic wealth building perspective, rather than seeing a rapid drop as a reason to panic, it can be framed as a structural reset. For those looking to capitalize on the overarching Middle East tensions, the earnings miss essentially provided a steep discount on the entry price.
Okay, so if we see how the chart is reacting, and we understand that institutional money is probing for a floor, the next logical question is, what is the match that lights the powder keg?
We need catalysts.
Right. What are the specific triggers over the next few months that could launch this stock back upward?
Well, we need to monitor a specific catalyst calendar, looking at 3 distinct tiers: the macroeconomic, the operational, and the financial.
Okay, let's start with the big one.
The macroeconomic tier is the ultimate blue sky speculative catalyst. We are looking at the potential closure or severe disruption of the Strait of Hormuz by Iran. And to understand the gravity of this, you really have to realize that the strait is a narrow geographical choke point between Oman and Iran.
And it handles a massive amount of oil, right?
Yes, it handles roughly 20% of the world's total crude oil shipments. It is the primary artery connecting the Persian Gulf to the open ocean.
And you can't exactly reroute ultra-large crude carriers through a quick detour.
Exactly. If that waterway gets bottlenecked, it creates a historic physical shock to global supply. And because global energy demand is highly inelastic, meaning people still need to drive, planes still need to fly, and supply chains still need to move regardless of the price.
The demand doesn't just go away.
Right. If 20% of the supply vanishes, the price of the remaining 80% doesn't just go up linearly. It spikes exponentially as nations scramble to secure their strategic reserves.
Wow. But let me push back on the inevitability of this catalyst for a second.
Huh.
We are essentially basing a wealth-building thesis on a geopolitical fear trade.
Yes, that's the core macro driver.
It feels a bit grim, honestly, to tie our strategy to global conflict. I mean, how do we objectively look at this data without getting caught up in the geopolitical anxiety? And what if that premium is a complete mirage? Like, what if diplomats step in, the tension's cool, and the market realizes it entirely overestimated the actual physical disruption to the supply chain? Are we just gambling on headlines here?
That is a very valid point, and it's the defining risk of the entire trade. It is a critical distinction to make, but you have to remember, the market is an emotionless, calculating machine.
It doesn't have morals.
Exactly. It is currently pricing in the probability of a disruption based on supply and demand, not a guaranteed certainty. If the geopolitical premium evaporates, the stock will absolutely re-rate downward.
Okay.
But alongside that macro catalyst, you also have localized operational triggers to watch. We are waiting for integration and drilling updates from those newly acquired 7,000 Texas acres.
So actual business results, not just global fear.
Right. Any positive news demonstrating high production rates or lower than expected drilling costs there serves as an immediate fundamental catalyst.
And we can't forget the financial catalyst.
Correct. The final official closing of that $15 million private placement. Once the ink is actually dry and those funds are fully secured, it legally and functionally removes the near-term liquidity concerns that have been weighing down the stock's valuation.
So we have the upside mapped out clearly.
Yeah.
But because we respect the reality of the market, we have to coldly and logically address the downside. Let's really dig into the risk assessment, the bear case.
It's essential.
Because every high leverage opportunity carries an equally heavy anchor of risk. If you're going to allocate capital here, you need to know exactly how it could blow up in your face.
You have to be extremely calculated here. The fundamental weakness we discussed at the top of the show is very, very real. A year-over-year revenue drop of 35% proves that this company struggled with operations long before the current Middle East tension escalated.
Yeah, their core business, absent a macro crisis, was contracted.
Exactly.
And we also have to hammer home the reality of high beta risk. We just discussed single-day 40% drops. High beta means this stock is highly unpredictable and hypersensitive to bad news.
It amplifies everything.
If you put a significant portion of your portfolio into this without understanding the volatility, you could suffer severe whiplash. You could literally go to sleep up 30% and wake up down 40% just because a single peace talk headline hit the newswires.
That is exactly the dynamic at play. If oil prices normalize, or if the conflict de-escalates, the stock faces a steep, immediate downside correction.
Because the fear premium is gone.
Exactly, because it simply won't have the internal earnings power or the operational efficiency to justify those elevated price levels on its own merits. The premium currently built into the stock's price is heavily, heavily reliant on the geopolitical fear trade. If the fear leaves the market, the premium leaves with it.
It's a tightrope walk. You are balancing a fundamental weakness against a massive macroeconomic tailwind. So taking all this into account, the ugly fourth quarter numbers, the Goldman Sachs supply shock warning, the strategic debt reduction, the massive chart volatility, and the very real downside risks. Let's synthesize this for the listener.
Let's bring it all together into a final investment thesis. When we weigh the fundamental floor created by their recent deleveraging and capital raises against the explosive upside potential of global energy bottlenecks, this setup scores a 7 out of 10 on the bullish scale.
7 out of 10.
It is a textbook high-reward, high-risk play. However, it is vital to categorize this correctly. This should not be viewed as a long-term buy-and-hold stock that you just tuck away in a retirement account.
Right. It is not a set it and forget its investment.
Not at all. It should be viewed as an event-driven swing trade for the short to medium term. To execute this effectively, it requires intense discipline.
You have to watch it like a hawk.
Yes. You need to be actively monitoring oil futures, tracking the volume of the stock to see where institutional support is forming, and honestly paying close attention to Middle East headlines on a daily basis.
It demands your active attention, and it demands an understanding of the mechanics behind the headlines. Well, as we wrap up today's analysis, I want to leave you with a final provocative thought to chew on.
Let's hear it.
Think about everything we just discussed today. While average retail investors might be panicking over a backward-looking Q4 earnings miss and running away from a volatile chart, sophisticated institutional money quietly stepped into a private placement to lock up $15 million in this exact company. What does that smart money know about the future of the global energy supply that the average investor might be missing? Thank you for joining the conversation today, and remember to keep actively building your financial knowledge.